Hello, everyone, and welcome to Economic Impact. Today is December 12, 2023. I am with Stéphane Marion, our chief economist. Stéphane, can we come back on what happened on rates and yield for the last year, on return, let's say?
Well, we can do that, but first let's speak to what we said last time. November was shaping up to be a good month, and there's been some follow-through in December. And the quarter to date is just spectacular. Denis, equity is up roughly 8%. Bond market is also up 6% as yields have come down. But to your question, how to qualify 2023 with 2 weeks to go in the year, it's been the story about equity markets. S&P 500, European stocks, even S&P TSX, emerging markets outperform any other asset classes. So it was the year of equities in 2023, Denis, but it was all on the back of multiple expansion, higher PEs. It's not because earnings were up.
That's quite interesting because, it's a little bit hard to see what will come in 2024. Let's go back to some economic news and let's talk about the supply chain here.
Yeah, so the multiple expansion is on the back of yields that are coming down and interest rates are coming down, long-term treasury yields, that is, Denis, bond yields are coming down because the supply chain, which was the most inflationary on record, has turned out to be now, has become the most deflationary in over a generation. That's why inflation is coming down and that's why yields are coming down. So no one could have predicted that the supply chain would come back in this kind of state so quickly.
Yeah, at the same time also we're seeing a deterioration in the factory operating conditions, and once again it's a kind of disconnect with what we see in the stock market.
Well, if it's deflationary, Denis, you're right. We need to ask what's happening, what's behind that deflation. And the reason for deflation is because higher interest rates have had an impact on the global economy. And we're seeing that from a factory's perspective. Everything that's related to manufacturing is actually stagnating or actually contracting in some parts of the world, such as Europe. So clearly, reason prices are coming down is because economic activity is lackluster. And that's how you normally have the impact on interest rates, bring down inflation. But the question is, Denis, what will it do on profits going into next year, right?
Yeah, that's what we're going to see in the coming months. But also at the same time, rates are still high and they are affecting the economy.
Yeah, hence the question about the so-called assumptions that earnings will rebound everywhere around the world in the context where Americans are devoting a record share of their income to in interest rate payments. So we've never seen this in the past. All I would say, Denis, under these conditions, I would think that growth will be significantly slower in the U.S. next year with a potential risk of recession. Hence the question about, is it normal for the stock market to give so much multiple expansion? The assumption that...
Or so much hope in the economy.
You're right. So it's a soft landing assumption at this point in time still, and we're still skeptical about that scenario.
Yeah, but every data that we're looking at, they are quite high or unusual for, a real slowdown and that people are expecting. Is it normal?
People tend to deny an incoming slowdown as long as possible. People tend to expect the best, but you're right. This is actual data about interest payments, but leading indicators are actually pointing to significant deceleration. Those are a number of indicators. We're seeing resilience right now until so far, but the leading indicators are pointing towards a deceleration. You're absolutely right.
Okay, and when you come back to Canada and you look at the performance of our stock market compared to the U.S., one of your favorite subjects is that there's still a big discrepancy. Is the Canada ahead of the U.S. right now, or the rest of the planet?
We haven't seen the same multiple expansion on this side of the border, which means that if you compare the U.S., which is the most important, the most expensive stock market on the planet at 19 times forward earnings, you can see Canada at roughly 13 times. The discount to the U.S. is a near record high, Denis, so almost 6 percentage points. So we've rarely seen this over the past, 30 years.
Wow. That's big. But at the same time, we're seeing that the economic data in Canada are really pointing down, and this is something we're seeing on the private domestic demand.
I won't deny that. And that's the reason we're not getting the multiple expansion. And when you look at the GDP data that was released for the third quarter in Canada, it was down 1%, and the US was up 5%, 5.2%. So a massive divergence. More importantly also is private domestic demand is also down. So it's not a good combination. Clearly the impact of interest rates is biting on the Canadian economy, hence the significant discount on the stock market this year.
Yeah, and remember the last time we're looking again at CPI. CPI is decreasing, but not everywhere.
No, so slower growth or economic contraction is leading to lower CPI inflation. You're absolutely right. Historically, we're just above 3% right now. So we had gone up to 4%. It's decelerating. But you can see on this slide, Denis, that why is it still resilient? It's mostly because of the gray line, the shelter component, which is 28%. If you exclude shelter, you're actually below 2%. So you should be in a position to cut rates aggressively, but I just can't give you that from a Bank of Canada standpoint because of the shelter component.
Mm-hmm. That's interesting, because otherwise it probably would have been in a period of time where we can really focus on rates coming down. But right now with that, it's postponed until we can see, an immigration slowdown, then less impact on the shelter and the price of, renting houses.
So that's a good point, because we're seeing why is shelter accelerating at this point in the cycle, and the Bank of Canada has finally come up with a study where they're no longer denying the impact of very, very strong population growth on the shelter component of CPI, which is a big component. So as of last week, the Bank of Canada recognizes that, there's a big impact there. And it doesn't mean that there won't be rate cuts in 2024. It's just they will be less aggressive than what we've had in the past. So we're looking at maybe 100 basis points, maybe a little bit more, but rates will still, at least they're coming down, Denis, but they'll still be high from an historical perspective.
Yeah, but also the impact of those pretty high rates right now are not the same in every province. Canada is a big country, but
you're right.
the impact of the rise of interest rate has impact differently in different provinces.
Yeah, you're absolutely right. It would be a mistake to assume that the impact of higher rates is the same across all regions. For example, if you look at real interest rates, so the overnight rate from the Bank of Canada, deflated by CPI ex shelter in every provinces, you can see that real rates are extremely restrictive in Alberta, 5% real rates. And at the other end of the spectrum, you have Quebec at 1.9%. But note, Denis, on this slide, anything above 1% real rates by this measure is considered restrictive. So it's restrictive policy, monetary policy everywhere in Canada, but you can see where certain regions might be more forcefully impacted in 2024.
On this note, thank you, Stéphane. Thank you all for being with us. We'll see you next month. Until then, the Impact Economic team wish you happy holidays.